Good morning, everyone. Today in the syllabus F7, we're going to be talking about IAS 16. IAS 16 talks about property, plant, and equipment. And in this chapter, we are going to learn how we are going to treat them in our accounting books. Now, let us first start off with the definition of property, plant, and equipment. Okay. The definition of property, plant, and equipment are intangible assets which are used in the production of goods and services. Now, you might be wondering, what does tangible mean? Tangible simply means it can be touched by hands. Okay, the definition of property, plant, and equipment is pretty simple, so we're going to move on to the recognition criteria. Now, for an asset to be capitalized in accordance to IAS 16, it first must meet the recognition criteria provided. Number 1, it is probable that future economic benefits associated with the asset will flow to the entity. Now, what does this mean? This simply means that income must flow to the entity. Okay, now we purchase an asset. An asset should bring economic benefits or income towards our entity. And the second recognition criteria, it says the cost of the asset must be measured reliably. Okay, now let's go back to the first criteria. It says it is probable. Probable usually means above 50%. That means there's a chance of above 50% that income is going to flow into our entity because of the non-current asset. Okay, now when we purchase a non-current asset, there are different costs associated with it. Now, some of these costs are allowed to be capitalized and some costs are not allowed to be capitalized. Now, we are going to see in the next slide what costs can be capitalized. Okay, we will first start off with the purchase price. Purchase price is the cost of buying the asset, the list price you can say. Now, we usually calculate the purchase price after deducting any discounts associated when we purchase it. Okay, next one is import duties. Sometimes when we bring assets from foreign nations, we will have to pay import or some other tax. Now that cost we will have to capitalize it. The third one is directly attributable costs of bringing the asset, such as cost of site preparation, initial delivery and handling costs, installation costs, testing costs, and professional fees. Professional fees can be such as designer fees, surveyor fees, and architect fees. These are just few examples of what professional fees can be. And the fourth one is what you call dismantling costs. Now, what is dismantling cost? Dismantling costs Okay, dismantling cost is the cost incurred to remove the asset and restore the site. Now, usually once the useful life of the asset is finished, there can be scenarios where we will have to pay to remove the asset. or to destroy the asset, you can say. Now, this is what you call dismantling cost. And sometimes when we build like a building, we will have at the end of the useful life. Now, to make a building, we might have maybe destroyed a forest or a plant or a garden. Now, sometimes we will have to restore the site. Usually, this is because of a government agreement. Dismantling costs are usually unavoidable because it is a government regulation, but some companies still account for this cost to follow company ethics. Now, we have learned the cost to capitalize. Let us illustrate this with an example. Peter has built a new factory incurring the following costs: land, material, labor, architect fee, surveyor fee, site overheads, admin overheads, testing costs, and business expenses for the first year. The question asks us, what is the amount to be capitalized in accordance to IAS 16? Now, Peter is building a new factory. Okay? Now, when we build a new factory, we will definitely have to pay for the land, material, labor. Now, let us look back. What are architect fees and surveyor's fees? If we look back to our costs for the list of the costs to be capitalized, we can see that this is what we call professional fees. Now, sometimes when we build a factory or we build a building, we will need to incur these professional fees. Now, in accordance to IAS 16, we are allowed to capitalize these two items. How about site overheads? Site overheads are basically the overheads which we will incur to prepare the site. This means that we are also allowed to capitalize this. Admin overheads of $150,000. Administrative overheads are usually office overheads, which has nothing to do with the factory. This means that we are not going to capitalize this cost. Testing costs is also part of the cost to be capitalized, meaning we are going to put this as our cost of the asset. Okay? Now, how about business expenses for the first year? Usually, when it comes to IAS 16, we only capitalize one-time costs, meaning the cost which we are only going to incur one time. Now, it says business expenses for the first year. If you think about it, doesn't this mean that in the second year, in the third year, in the fourth year, we will still have to pay for it? Due to that reason, we are also not going to capitalize this. Now, if we add all the items that we have to capitalize, we are going to get $5,950,000. Okay? Please note that all these costs to capitalize are very important for the ACCA F7 examinations. We have learned that we value non-current assets at cost. We have learned that initially we value assets at all the costs in the list provided. Now, once we are done with the initial measurement, there are two ways we value non-current assets after initial measurement. Remember, the initial measurement, we value our property, plant, equipment at cost. Okay? Now, the first one is what we call carrying value. And the second one is a revaluation value. Some of you might still remember carrying value is cost minus accumulated depreciation. You might be wondering, what is accumulated depreciation? Accumulated depreciation is simply the depreciation from previous years combined. Supposing, if last year I had a depreciation of 5,000, this year I have a depreciation of 5,000. That means my accumulated depreciation is 10,000. The second one is what we call revaluation value. I will first explain in the following slide carrying value. Now let us review something from your F3 module. As I said, carrying value equals cost minus accumulated depreciation. Now, how do we calculate depreciation? In F7, we will learn two ways to calculate depreciation. The first one is a straight line method. And the second one is the reducing balance method. The straight line method is simply cost minus residual value divided by useful years. Useful years or useful life of the asset. Okay, now what is cost? Cost is the amount we are going to capitalize in accordance to IAS 16. We have learned from the previous slide that what are the types of costs we will capitalize, such as purchase price and professional fees, testing costs, and other things. Now, what is residual value? Residual value is the amount of money Okay, residual value is the amount of money, the amount of money we can obtain when we sell the asset at the end of its life. This is what we call residual value. Useful life of the asset is simply how long we can use the asset for. Okay, now this is how we calculate straight line method. How about reducing balance method? In reducing balance method, we usually, let me explain this in the next slide. Reducing balance method. Okay, now, the first year of reducing balance method will be cost times the depreciation percentage. Okay, now you will get your depreciation for the first year. In the second year, it will be not cost, but it will be carrying value. Carrying value multiplied by the depreciation percentage. Okay, now remember, to calculate carrying value is cost minus accumulated depreciation. Okay, remember in the first year it will be the cost times the depreciation percentage, and the second year will be the carrying value, not the cost, times the depreciation percentage. The depreciation percentage will already be given in the question. Now to make this clearer, let's try doing an example. Okay, Andrew purchased the building for $100,000. Depreciation is to be charged 20% per annum using reducing balance method. Calculate depreciation for 3 years. Now, in year 1, what will be my depreciation? It will be $100,000 times 20%, which equals to $20,000. Okay, in our second year, now if you see in the previous slide, we do not use cost, we will use carrying value. So how do we calculate carrying value? Carrying value will be my cost minus my accumulated depreciation times 20%. Okay, 80,000 times 20%, which will lead to $16,000. Yes? Now, let us do for year 3. We will have $100,000 as our cost. And what will be our accumulated depreciation in year 3? We first have a depreciation of 20,000 in year 1. And in year 2, we have a depreciation of 16. That means now my accumulated depreciation is $36,000 times 20%, and that will be our depreciation for year 3, which becomes to $12,800. Okay. Remember, this is under reducing balance method. First year is based on cost, and the next years are based on carrying value. Carrying value is simply cost minus accumulated depreciation. This was our first way to value our non-current assets, carrying value. Okay, we have calculated depreciation. Now this 20,000, all these three things will be expensed in the profit and loss. Okay, now following this example, let me show you how will we treat it in the statement of financial position. Now, supposing this is my statement of financial position, okay, say year 1, year 2, and year 3. Okay, I have something called building, yes. Now, in the statement of financial position, we always value property, plant, and equipment at their carrying value. Okay, carrying value will be cost minus accumulated depreciation. In year 1, my cost is $100,000. My accumulated depreciation will be $20,000. This means in year 1, I will value my building at $80,000. Yes, in year 2, it will be $100,000 minus $20,000 minus $16,000, which leads up to $64,000. And in year 3, we will have $64,000 minus another $12,800, which becomes $51,200. Okay, remember, depreciation is charged to the profit and loss. And in the statement of financial position, we always value property, plant, and equipment at their carrying value or their revalued value. We have now learned carrying value, and in the later slides we will learn about revaluation. Okay? Now, there can be another scenario another scenario where the depreciation policy is changed through the life of the asset. An example would be like this. Yes, Andrew purchased the machinery for $100,000 on 1st January 2010. Useful life of the asset is 10 years. when they give useful life, now we know that we will have to use the straight line method. Okay, on 1st January 2013. Now, if you see, 3 years have already passed, and now they're reviewing the depreciation policy. It says depreciation policy was changed to reducing balance method at 20% per annum. Okay, now when we are given a scenario like this, where partway through the year they're changing something, changing the depreciation policy, or changing the useful life, or changing the value of the asset by a revaluation, we will always have to first calculate the carrying value before calculating the new depreciation. Okay, let me repeat that again. We calculate the carrying value before we calculate the new depreciation. Now, it says that on 1st January 2010, the machine was bought at a cost of $100,000. Yes? Now, it is the depreciation policy is being changed on 1st January 2013. This means that we will have to find the carrying value on 1st January 2000, or you can say carrying value on 31st December 2012. Okay, we will have my cost of $100,000 minus 100,000 divided by 10 years, yes, cost over useful life, times 2 years have passed, right? 2010, 2011, 2012. Oh, sorry, 3 years have passed, that means. Yes? That means now what is my carrying value? My carrying value on 31st December 2012 would be $70,000. My depreciation per year is $10,000, which is 100,000 divided by 10, and 3 years have passed. That means my accumulated depreciation is 30,000. My carrying value would then be cost minus accumulated depreciation, which would be 100 minus 30, which equals 70,000. Now, on 1st January 2013, depreciation policy was changed to reducing balance method. This means, how do I calculate depreciation for 2013? Now, I will always calculate depreciation on the carrying value. My carrying value is $70,000, and the reducing balance charge is 20% per annum. Yes, that means now my depreciation for the year will become $14,000. Now remember where we put this $14,000? Yes, $14,000 we will expense it off in the profit and loss. Yes? Now, how about following this example in the statement of financial position, or in the SOFP, how will we value our machinery? It will be on carrying value. Say, let me write this SOFP. As at 31st December 2013, I will value it at $70,000 minus the depreciation for the year, which will be $56,000. Yes? Okay, hopefully this example made it simple for you guys. Now, let us talk about revaluation. Okay, before I move on to revaluation, let me just remind you guys, when there is a change in the depreciation policy, or a change in the useful life, or even if there's a revaluation, we will always calculate depreciation at the new amount, okay, at the carrying value. Now, when I calculate depreciation for 2013, I don't use $100,000 again. I use the carrying value. Okay. Now, let us talk about revaluation. Okay. Revaluation. Revaluation takes place. Okay, let me explain first what is revaluation. Revaluation simply means that the value of our asset is now changed. Okay, now it can go up, meaning the value of our asset goes up, or it can go down. Now when it comes to revaluation, okay, when it comes to revaluation, we compare two things. One is the carrying value, or the fair value. Okay, we want to find out the difference between the carrying value of our asset and the fair value of our asset. Now, what is fair value of our asset? Fair value asset simply means the market value. This means if I want to buy this same type of asset today, it will cost me a certain amount. This is what I call fair value or market value. Yes, and carrying value is what we discussed earlier. Cost minus accumulated depreciation. Okay, we compare two things, carrying value and fair value. Carrying value is my cost minus accumulated depreciation, and my fair value is my market value. In the scenario, usually fair value is always given in the question. Now, if my carrying value, if fair value of the asset is greater than the carrying value, this is what we call a revaluation upwards, or a surplus. Okay, if my fair value is less than my carrying value, then this is what we call a revaluation downwards. Okay. An example would be like this. Let me give it an example. Okay. The carrying value of a machinery Okay, the carrying value of a machinery was $80,000. The fair value is $85,000. Now let us analyze it in this manner. In our books, the value of our machinery is $80,000. But if we want to buy that same asset or the same machinery today, it would be $85,000. This simply means now my fair value is greater than my carrying value. This means it's a revaluation upwards of 5,000. Okay, now what happens when a revaluation takes place? Let me show it to you in the next slide. This is the double entry. Okay, I will debit my machinery or my PPE, and I will credit my revaluation reserve. Okay, now why do I debit my machinery or PPE? This simply means that the value of my asset has gone up by an additional $5,000, and now in revaluation reserve also has a amount of $5,000 inside it. Now where is revaluation reserve in? This is in the statement of changes in equity. Yes? That means now, if I show you the statement of changes in equity, it would look like this. I would have my share capital, share premium, retained earnings, and my revaluation reserve. Okay, the statement of changes in equity looks like this. Now I will have a revaluation, and now in my revaluation reserve I will have a positive amount of $5,000. Okay, this is what it will look like in this statement of changes in equity. Now how about in the financial position? Okay, now let us assume that this value, the fair value, is 85,000 at the year end. Okay. Now, what will happen in my statement of financial position? I will have under my non-current assets, I would have my property, plant, and equipment. Now, what value do I use? I will no longer use the $80,000. Why? Because now my asset has a new value of $85,000. Okay? Remember, my revaluation will go in the revaluation reserve by the difference of $5,000, and in my statement of financial position I will write it down as $85,000, meaning the new value associated with the non-current assets. Yes? Now, revaluation also has to be shown in one more place. Yes? Okay, now let's, example, I would say just profit for the year. This is just an example. Let's put it as $26,000. Okay, now I will have a other comprehensive income section below this. I will write revaluation upwards. Of $5,000. Okay, that means now my profit and loss will be closed by $31,000. Okay, remember, profit for the year will go where? Profit for the year will go to retained earnings. Yes, this is also in the statement of changes in equity, and this $5,000 of revaluation upwards will go to your revaluation reserve. Okay, let us review again. If the fair value is greater than the carrying value, this is what we call a revaluation upwards. If my fair value is less than my carrying value, this is what you call a revaluation downwards. Now, with this example, I explained that there is a increase in a revaluation. The value of the asset has gone up by $5,000. This means this is a revaluation upwards. Why? Because my fair value is greater than my carrying value. Now, when a revaluation takes place, it will affect three things. One is the statement of changes in equity, meaning in my revaluation reserve, I will have to write the difference of $5,000. Second one is in my statement of financial position. I will value it at the new value or the fair value if the revaluation takes place at the end of the year. For an example, if this happened at the beginning of the year, meaning the revaluation happened at the beginning of the year, then simply I would just have to depreciate it again for the following period. Yes? And the depreciation will also be charged at the profit and loss. Okay? The third place where we put revaluation is in the other comprehensive income, where I will write down $5,000 or the difference also. Okay? Three things to remember. we have looked at what happens when a revaluation upwards take place. By revaluation upwards, I mean that the fair value of my asset is greater than the carrying value. Fair value is simply the market value, and carrying value is the value of the asset in my books, which I calculated using the formula cost minus accumulated depreciation. Now, let us see this scenario. Andrew has a machinery which has a carrying value of $80,000. The fair value was $85,000. Now, from this part, this is the same as our previous example. Now, it says in the next year, the fair value has gone down to $81,000. So, can I say that when it went from 80,000 to 85,000, this was this one was a revaluation upwards. Yes, because my fair value is greater than my carrying value. But now, what is happening? If we see, in the next year, the fair value has gone down to $81,000. That means from 85,000, now it's gone down to 81,000. Now this is what we call a revaluation downwards. Yes? Now, let us see what happens when a revaluation downwards takes place after a revaluation upwards has taken place in the previous year. When we start the statement of changes in equity, we have a balance brought down. Because from the previous example, our revaluation reserve has a positive figure of $5,000. Why? Because in the previous year we had a revaluation upwards. Now, if you see, the fair value has gone down to $81,000. From 85, it has dropped to 81. Now, if you see, this is what you call a revaluation downwards of $4,000. Yes? That means, when I close the year, how much do I have left? I start the year with $5,000 on my revaluation reserve. Then, unfortunately, I have a revaluation downwards of $4,000. That means I close my year with $1,000 remaining in my revaluation reserve. Yes? Now, let us see what happens in the statement of financial position. My non-current asset has gone from $85,000 to $81,000. That means in this year, the value of my asset is no more 85, but $81,000. Okay? Now, as I said, when a revaluation takes place, it will affect three different things. One is the statement of changes in equity, the other is the statement of financial position, meaning the value of the asset, and the third one is the statement of profit and loss and other comprehensive income. Okay, let me just put an example of my profit for the year. Say I have $26,000. Okay, now I will have my other comprehensive income. Okay. Now, in this scenario, it is not a revaluation upwards. Instead, it was a revaluation downwards. Yes, by $4,000. That means I'm now left with $22,000. Okay? Now, again, where does this profit for the year go to? This will go to the retained earnings. And where does my revaluation downwards? This will go to the revaluation reserve. Okay. You see in my statement of changes in equity, I've written in my revaluation reserve as $4,000. I've already deducted $4,000. Yes? This was our second scenario. So, we so far have learned two scenarios. The first one, we have a revaluation upwards. Yes? And in the second scenario, we have a revaluation upwards in 1 year, and then in the next year, we have a revaluation downwards. Now, the third scenario we're going to learn is let me put this in an example. Yes? Okay? Andrew has a machinery with a carrying value of $80,000. In the previous year, the fair value of the asset was $85,000. Now, in this period, the fair value of the asset is $78,000. So what happens here? It went from 80 to 85 in the previous year, which was a revaluation upwards. But now, if you think about it, the value from $85,000 has gone down to $78,000, which means this is also a revaluation downwards. Yes? Now, what happens in this scenario? We will have our statement of changes in equity. We have share capital. We have share premium. We have retained earnings. And we have our revaluation reserve. Yes? Now, let us see, when we start the year, that means this is also from our previous example, we have a balance brought down of $5,000 in our revaluation reserve. Why? Because in the previous year, the value from $80,000 rose up to $85,000, leading to a $5,000 increase in the value of the asset. Thus, the revaluation reserve goes up by $5,000. But what happens in this period? The fair value of the asset is $78,000. Now, if you think about it, the difference is $7,000. But don't you think we only have $5,000? So how do we take out more than what we have? I have a revaluation downwards of 7,000. But can I write 7,000? No, I am not allowed to do that, as I only have $5,000 in my revaluation reserve. Okay, so let us first minus $5,000 first. That means in my revaluation reserve, I close the year with 0. Yes, but now you might be thinking, we have a revaluation downwards of $7,000. How is it we are only deducting $5,000? Now, the remaining $2,000, we are going to recognize it as an impairment loss in the statement of profit and loss. Under other expenses, we are going to expense off this $2,000. Yes, let me first show you what happens in the statement of financial position. Okay, as I said, we will always value our asset in the statement of financial position at the latest value. I will have my property, plant and equipment. Okay. Do I take $80,000? Do I take $85,000 or do I take $78,000? Okay, I will take $78,000 because it is the fair value of this current period. Okay, simple. Now let's do the profit and loss. Yes, I will have my statement. Okay, I will have my gross profit. Let's say $40,000. Yes. Now I will have something called expenses. Yes, last expenses. Say I have distribution costs. I will have administrative expenses. Okay. Say distribution cost is $10,000, $5,000. Yes. Now I will have something called other expenses. Okay, and in this other expenses, let me just write it as impairment loss. Okay. The value of our asset has gone down by $7,000, but our revaluation reserve only had $5,000. That means we do not have enough, or we are not sufficient enough to deduct everything from the revaluation reserve. Our revaluation reserve only has $5,000. So okay, we take $5,000 from there. Now our revaluation reserve is empty. But the value of our asset went down by $7,000. So what are we going to do with the remaining $2,000? We are going to expense it off in the profit and loss. Yes, and other expenses as impairment loss, we are going to expense it off. Okay, now what is my total expense? This one will become $17,000. Yes, which means my profit for the year will become $23,000. Now, remember, in my other comprehensive income, yes, I will have my revaluation downward of $5,000. Why do I only take $5,000, not $7,000? Because the other $2,000 I already expensed it off in the profit and loss. Now, the remaining $5,000, which I removed from my statement of changes in equity, I will expense it off in the other comprehensive income. That means now my remaining profit is only $18,000. Okay, let me review this again. We had a revaluation downwards of $7,000, but we did not have enough money in the revaluation reserve. So we minus $5,000 from there because that was all that we had. And the remaining $2,000 we expense it off in the profit and loss statement. Yes, this $23,000 will go to retained earnings. And my $5,000 we will deduct this from the revaluation reserve. Okay, that means so far we have learned 3 ways. The first one was my revaluation upwards, just a general revaluation upwards. My second one was revaluation upwards, followed by a revaluation downwards, and my third one was revaluation upwards, downwards. But in the third scenario, my revaluation reserve was not enough. Okay, 3 scenarios to remember under IAS 16. Okay, now so far let's make a summary of what we have done so far. Yes, we talked about IAS 16, which refers to property, plant and equipment, or PPE. Yes. Now, we value it at cost. The initial measurement yes. Now, remember what is included as part of the cost. Cost, please look at the list of things to capitalize. Okay? Now, after initial recognition, there are two ways. One is the revalued value, or my carrying value. Which is cost minus accumulated depreciation. Yes. Please remember from the previous slides what enter the changes in equity, what enters the profit and loss, what enters the financial position. Yes? Now, after this summary, we are going to start with something new. Maybe some of you have never heard of this. This is what you call complex assets. Okay? Complex assets are assets which are made up of separate components. Each component is separately depreciated over their useful life. Yes? Now, basically this is an asset which has many different components. Now, those components will of course have different useful lives and different values. This is very common when it comes to the airplane industry. Why? Because in an aircraft you have many different components, and each component has separate values and it has separate useful life. Okay? To illustrate this, we will do an example. Now, it says it gives the following costs and it gives the useful life. Fuselage, undercarriage and engines. This is part of an airline or an aircraft. Yes? During the year, 150 flights were made which took 400 hours. Now, our job is to calculate depreciation at the end of the year. Okay? Now let me start with my fuselage. I will calculate depreciation. It says the cost is 20,000 and my useful life is 20 years. Hence, my depreciation would be 20,000 over 20 years, which equals $1,000 per year. Okay? Now, how about my undercarriage? It says my cost is $5,000 and my useful life is not based on years, but it is based on landings, 500 landings. Okay? This means that the undercarriage can be used for 500 landings. Now, let's read the question again. During the year, 150 flights were made, which took 400 hours. Depreciation at the end of the year is to be calculated. If we have 150 flights, this means our landing would also be 150. Hence, my depreciation would be 5,000 times 150 over 500. Yes? Or you can put it 5,000 divided by 500. Yes, 500 hours, 500 landings I mean, and we used 150 of it, which would make up to $1,500 as our depreciation. Yes. Now how about our engines? It says the cost is $8,000 and it has a useful life of 1,600 flying hours. And during the year we used 400 hours. This would make our depreciation for the engines to $2,000. Yes, so the total amount to be expensed in the profit and loss would be $1,000 plus 1,500 plus $2,000. $4,500. Okay. Let's review again what is complex assets. Complex assets are assets which are made up of separate components. Each component is also an asset. That is why they have different costs and they have different useful lives. So we will calculate depreciation for 3 different parts of the aircraft. Okay? Now, when it comes to aircraft, there is something also called overhaul. Overhaul means okay. Overhaul means to upgrade or to improve. Keyword is upgrade or improve an asset. Now, overhaul costs, we have to capitalize it. Okay. Now, overhaul is also very common when it comes to the aircraft industry. Why? Because usually after a few years, a machine or an engine will need to be upgraded in order to improve the asset. Okay? Now, what do we do when it comes to overhaul costs? Usually, overhaul costs, we will have to incur it after a few years. Maybe after 4 or 5 years, then we will have to upgrade it to ensure that it brings better productivity or capacity to our asset. Now, so what should we do? Should we capitalize it then or do we capitalize it now? Overhaul cost needs to be capitalized now. Why? Because we can already foresee the expense. Yes? Let us illustrate this with an example. Okay, An aircraft needs overhaul after 3 years, which costs $1.2 million. This will probably mean either the engine or the machine of an aircraft would need an upgrade after 3 years. Now, we can already foresee the expense. That is why we must already capitalize it. Now, once we capitalize it, means we will have to depreciate it, even though we will only be incurring this expense after 3 years. $0.4 million or $400,000 per year will be added to our depreciation charge. Okay, now this basically ends our IAS 16 property, plant and equipment. If you have any, please email me at Okay. If you have any questions, you can please feel free to email me at viraj.keswani@lsafglobal.com. Hope to hear from you guys soon, and thank you for watching this video.